Hey everyone, I'm Alina, COO at AKM, and whilst everyone's obsessing over ROAS and click-through rate, I'm looking at the metrics that actually predict whether your business will survive this year and be able to scale into 2026. After managing the finances for brands doing 500 million plus in revenue, I can tell you that the metric everyone talks about are not the ones that matter. Today, I'm going to show you the 3 financial metrics that actually predict success and how to use them in 2025. Firstly, why do traditional metrics lie? Well, unfortunately, I'm gonna start with something that's gonna hurt. Your ROAS is lying to you, your conversion rate is lying to you, and yep, you've guessed it, your average order value is lying to you. Here's why. So these metrics tell you what happened and not what's going to happen. They're what I like to call lagging indicators, because by the time they show you your problems, you're already in trouble. I'll give you an example of a brand that came to us. They were celebrating a 3.2 ROAS and a 4.5 conversion rate, which looks incredible on paper. But when I dug deeper, I found out that they just had 45 days of cash left. So they looked profitable on paper, but they were dying in reality. Don't be that brand. Stop obsessing over vanity metrics and start tracking the numbers that actually predict survival and growth. What are the 3 metrics that actually matter? Metric number 1, customer acquisition payback period. This isn't just CAC divided by margin, this is how long it actually takes to get your cash back from a customer acquisition investment. Here's how you calculate it. You take your total acquisition cost, so that's everything that you spent to get that customer, that's your paid ads, plus your creative, plus even the time your team spent. You divide that by your monthly profit per customer, and then you factor in your cash conversion cycle. You have a healthy benchmark, so your code red if you're anything under 90 days. You're in the warning zone if you're 90 to 120 days, and you're in the danger zone, so code red, you should be panicking if you have one that's 120 days plus. But don't worry, I'll share exactly how to track and fix these metrics a little bit later in the video. But first, here's why it actually matters. I've seen brands with 6-month payback periods wondering why they can't scale. You simply can't grow if it takes half a year to get your money back. Don't aim to be one of those brands. Metric number 2, cash conversion cycle. This is a big one. It's essentially how long from when you spend money until you get money back in your bank account. So days to pay your suppliers, plus the days your inventory sits, plus the days to collect it from your customers, minus the days you can delay your supplier payments. A healthy benchmark is anywhere under 60 days. You're in the warning zone between 60 to 90 days, and you're again in code red if it's 90 days plus. Let's talk through a real world example here. So we had a brand come to us doing 5 million annually with an 110-day cash conversion cycle, which means they needed 1.5 million in working capital just to maintain their current revenue. When they wanted to grow by 50%, that means they needed another 750K, which they just didn't have. So instead of scaling, it made much more sense to go back and actually fix that problem first. Metric number 3, contribution margin after cost. No, not your gross margin, not your contribution margin that ignores half of your costs, your real margin after everything. So this includes product costs, shipping and fulfillment, payment processing, returns and refunds, customer service, and chargeback and disputes. A healthy benchmark for this is 25% plus after all costs, so you're in the green there. You're in the warning zone between 15 and 25%, and you're in the danger zone under 15%. Now, let's talk about how these metrics actually work together, because this is where it gets interesting. These 3 numbers don't just exist in isolation. They create a system, and when you understand that system, you can tell instantly whether a brand is healthy or on life support. Let's talk through scenario number 1. This brand has a payback period around 60 days, a cash conversion of 45 days, and a true contribution of 30%. This business is a business that's built to scale. It's a healthy business. They get their money back fast, their cash flows smoothly, and that margin gives them a buffer for when things go wrong. Scenario number 2. So this brand has a payback period of 150 days, a cash conversion of 90 days, and a true contribution margin of 18%. This business is one problem away from bankruptcy. It's unhealthy, they can't scale, they can't handle seasonality, and a single supply chain hiccup would wipe them out. See the difference? Same market, same industry, but completely different outcomes, all because of how these three metrics work together. How do we actually track these? We know how to calculate them, but how often should we be checking in on these metrics? Let's break that down. Let's start with weekly tracking. On a weekly basis, make sure you update your cash position, you monitor your payback trends, and track your contribution margin, not just your overall, but by product. Then every month, go deeper. Review your full cash conversion cycle, look at your payback period by channel, and do the margin analysis by customer cohort. And quarterly, take it from a COO, that is for planning. Forecast based on the metrics I mentioned, set your targets for improvement, and plan your growth within these constraints. Now we know how to calculate them, when to track them, but what about the red flags? How do you know when your business is about to go into the warning or the danger zone? For payback periods, if they're increasing month over month, or they vary wildly by channel, or are longer than your cash runway, that's a problem. For cash conversion, if you notice it's getting longer, or if seasonal spikes could break you, or if you need constant financing to survive, those are big red flags. And look, I'll be honest, spotting these red flags is like spotting them in dating. If you don't look closely or ask the right questions, you'll only notice them when it's too late. That's why this tracking matters. Do it consistently and catch those red flags early. That way you can fix the problems before they sink you. What to do when your metrics are bad. If you've just calculated these metrics and you're in the warning or danger zone, or even you've been tracking them consistently and you're starting to notice those metrics slip, don't worry. I'm going to break it down for you by each metrics and tell you exactly what you should do to fix each one. If your payback period is too long, improve retention and lifetime value. That way customers spend more over time. Reduce your acquisition costs and avoid overpaying for new customers. And then focus on the high margin customers who deliver the real profitability. If your cash conversion is too long, negotiate better supplier terms so you're not paying out too early. Improve your inventory forecasting to avoid typing up cash in dead stock. And then optimize your fulfillment speed to get products out and money in faster. If your contribution margin is too low, audit all the cost centers to identify where your money is leaking. Then improve operational efficiency to lower expenses. And lastly, raise prices or reduce costs where it makes strategic sense. The bottom line. Look, I know this isn't as exciting as talking about the latest Facebook ad hack, but these three metrics will tell you more about your business's future than any vanity metric ever will. I've seen brands with terrible ROAS that were incredibly healthy businesses. I've also seen brands with amazing ROAS that went bankrupt 6 months later. The difference is they understood these three metrics. If you want help calculating and tracking these metrics for your businesses, hit the link below. Our team does free audits and I'll personally walk you through your numbers. And remember, you can't manage what you don't measure, and you can't measure what you don't understand. So please make sure you track those metrics, guys. That's all from me. Peace.